Hello everyone, I'm Rupert and let us talk about money. Today, I want to talk about endowments. Now, I know what some of you are thinking. Rupert, aren't those just for old school savers? Actually, endowments are still one of the most common ways Singaporeans save for their kids' uni fee or their own retirement. But here is the thing. Most people just look at the policy illustration and sign on the dotted line without knowing how the engine actually works. Today, I'm going to show you what's under the hood so you can decide if it's actually a fit for your wallet. Let's keep it simple. If you talk to an advisor today, you are usually looking at one of these four structures. First, traditional term endowment. These have a fixed end date, while common ones are pay 5, mature in 10, or pay 10, mature in 10. Many insurers now offer a lot of flexibility. At the start, you can actually mix and match, choosing a premium term and a policy term that specifically fits your timeline. For example, if you need the money exactly when your child turns 18, you can fix the term as such. Second, whole life endowment. Despite the name, you still only pay premiums for a short fixed time, maybe 5 or 10 years, but the plan doesn't end until you are 99 or 120. These are great if you want to leave a legacy or a perpetual money growth engine. Third, Flexi endowments. These are for people who hate locking money away because they allow partial withdrawals or annual cashbacks. Pro tip here, if you don't actually need that cashback every year, you can usually choose to leave it with the insurer to redeposit it. This let the extra cash compound at their prevailing interest rate, which helps your pot grow even faster. And lastly, index fund endowments. This is the new kid on the block. Instead of the insurer managing the money in the traditional way, these are linked to passive index strategies. You get market-like returns within the disciplined endowment structure. Now, why would you choose this over just buying stocks? The pros is about sleep. Most traditional endowments offer a capital guarantee at maturity. Even if the stock market crashed the day before your plan matures, your principal is safe. You also force discipline. It makes you safe. The cons, you are trading high returns for safety. If the market goes to the moon, your endowment won't follow it all the way up because the returns are capped. Also, liquidity is poor. If you try to cancel it in the first few years, you will lose money guaranteed. This is the part where I need you to pay close attention. When you look at your policy illustration at the surrender value page, you will see columns for 3% and 4.25%. I need to be very direct here. These are not your actual returns. These are just illustrative rates set by the industry to show you what if scenario. If you want to see what you're actually paying, look for a table called the effect of deductions. This shows you how much of that returns is being taken out for the insurance costs and management fees. Your actual net yield is what is left over after those deductions. Your actual payout depends entirely on the par fund performance. To get a real sense of what to expect, refer to the par fund performance history, which usually included in your PI. It shows how the insurers have actually performed in the past. You can also refer to the par funds report, which insurers are required to send you annually once you have the plan. Don't just buy based on projections. Look at the track record. So, where is the insurers putting your money? Most Singaporeans' par funds are bonds heavy, usually 60 to 70% in high grade bonds for safety, and the rest in stocks and property for a bit of growth. They also do something called the smoothing of bonuses. Think of it like a rainy day fund. In the year where the fund makes 10%, they might only give you 4% and keep the rest in reserve. Why? Because in the year where the fund loses 5%, they can use the reserve to still give you a bonus. It's designed to give you a steady, smooth ride rather than a roller coaster. The bottom line, endowments are your defense. They are for the money you cannot afford to lose. Use them for your child's university fee or to build a guaranteed floor for your retirement income. They aren't meant to make you a millionaire overnight. They are meant to make sure you have money when you actually need it. Endowments are the foundation. And if you want to grow the rest of your portfolio aggressively, you need to understand the world of active investments. Next time, I'm inviting our team's investment head to share some pointers on how we navigate the market beyond the guarantee space. You will want to hear what he has to say. If you want to learn more, just subscribe to my channel or follow me on Instagram so you won't miss out on the content that will definitely benefit you and your wallet. Goodbye.